D. Stock splits and the invisible foot. We are often asked why Berkshire does not split its stock. The assumption behind this question usually appears to be that a split would be a pro-shareholder action. We disagree. Let me tell you why. One of our goals is to have Berkshire Hathaway stock sell at a price rationally related to its intrinsic business value. But note, rationally related, not identical. If well-regarded companies are generally selling in the market at large discounts from value, Berkshire might well be priced similarly. The key to a rational stock price is rational shareholders, both current and prospective. If the holders of a company's stock and/or the prospective buyers attracted to it are prone to make irrational or emotion-based decisions, some pretty silly stock prices are going to appear periodically. Manic-depressive personalities produce manic-depressive valuations. Such aberrations may help us in buying and selling the stocks of other companies, but we think it is in both your interest and ours to minimize their occurrence in the market for Berkshire. To obtain only high-quality shareholders is no cinch. Miss Astor could select her 400, but anyone can buy any stock. Entering members of a shareholder club cannot be screened for intellectual capacity, emotional stability, moral sensitivity, or acceptable dress. Shareholder eugenics, therefore, might appear to be a hopeless undertaking. In large part, however, we feel that high-quality ownership can be attracted and maintained if we consistently communicate our business and ownership philosophy, along with no other conflicting messages. And then, let self-selection follow its course. For example, self-selection will draw a far different crowd to a musical event advertised as an opera than one advertised as a rock concert, even though anyone can buy a ticket to either. Through our policies and communications, our advertisements, we try to attract investors who will understand our operations, attitudes, and expectations. And, fully as important, we try to dissuade those who won't. We want those to think of themselves as business owners and invest in companies with the intention of staying a long time. And we want those who keep their eyes focused on business results, not market prices. Investors possessing those characteristics are in a small minority, but we have an exceptional collection of them. I believe well over 90%, probably over 95% of our shares are held by those who were shareholders of Berkshire 5 years ago, and I would guess that over 95% of our shares are held by investors for whom holding is at least double the size of their next largest. Among companies with at least several thousand public shareholders and more than $1 billion of market value, we are almost certainly the leader in the degree to which our shareholders think and act like owners. Upgrading a shareholder group that possesses these characteristics is not easy. Were we to split the stock or take other actions focusing on stock price rather than business value, we would attract an entering class of buyers inferior to the existing class of sellers. Would a potential one-share purchaser be better off if we split 100 for 1 so he could buy 100 shares? Those who think so and who would buy the stock because of the split or anticipation of one would definitely downgrade the quality of our present shareholder group. Could we really improve our shareholder group by trading some of our present clear-thinking members for impressionable new ones who prefer paper to value, feel wealthier with 9 $10 bills than one $100 bill? People who buy for non-value reasons are likely to sell for non-value reasons. Their presence in the picture will accentuate erratic price swings unrelated to underlying business developments. We will try to avoid policies that attract buyers with a short-term focus on our stock price and try to allow policies that attract informed, long-term investors focusing on business values. Just as you purchased your Berkshire shares in a market populated by rational, informed investors, you deserve a chance to sell, should you ever want to, in the same kind of market. We will work to keep it in existence. One of the ironies of the stock market is the emphasis on activity. Brokers, using terms such as marketability and liquidity, sing the praises of companies with high share turnover. Those who cannot fill your pockets will confidently fill your ear. But investors should understand that what is good for the croupier is not good for the customer. A hyperactive stock market is the pickpocket of enterprise. For example, Consider a typical company earning, say, 12% on equity. Assume a very high turnover rate in its shares of 100% per year. If a purchase and sale of the stock trades at book value, the owners of our hypothetical company will pay, in aggregate, 2% of the company's net worth annually for the privilege of transferring ownership. This activity does nothing for the earnings of the business and means that 1/6 of them are lost to the owners through the frictional costs of transfer. And this calculation does not count option trading, which would increase frictional costs still further. All that makes for a rather expensive game of musical chairs. Can you imagine the agonized cry that would arise if a governmental unit were to impose a new 16 2/3% tax on earnings of corporations or investors? By market activity, investors can impose upon themselves the equivalent of such a tax. We are aware of the pie-expanding argument that says that such activities improve the rationality of the capital allocation process. We think this argument is specious and that, on balance, hyperactive equity markets subvert rational capital allocation and act as pie shrinkers. Adam Smith felt that all non-collusive acts in a free market were guided by an invisible hand that led an economy to maximum progress. Our view is that casino-type markets and hair-trigger investment management act as an invisible foot that trips up and slows down a forward-moving economy.